Don't do that deal. Hey, Small Axe community, it's your boy Nico. This show is dedicated to helping you use your small axe to build a personal empire. So, on this show, I'm going to share some real, raw, behind the scenes info that's going to help you build your own multifamily portfolio. So, if you enjoy this show, I would love it if you can share it with somebody that you think could get value from it and write a review. It's the only way that we can grow this thing. Now, let's get to work. Let's jump into this episode and start sharpening those axes. Guys, today we're going to talk about something that every multifamily investor needs to hear. So the majority of the deals that you're going to look at are not going to work out. And you're going to get close on some deals. You might get into some under contract, you might go through DD, and then you're tied emotionally, you're tied financially to a deal, and you still go through with a deal when maybe you shouldn't. So today, let's talk a little bit about it. You should not do every single deal. Just because a broker is putting a deal out there for you to, marketing a deal for you to see, doesn't mean that's the deal that you should be doing. And in fact, 1 out of every 100 or so will actually make sense. So what does that mean for us as multifamily investors? It means a lot of frustration, a lot of patience. It means analyzing as many deals as possible to get to that 1 out of 100 that will make sense. Here's a quick example. I had underwritten a couple hundred deals at that point in time for this particular story. We got a deal under contract. It was a 9-unit and with a potential for 10 units. And right then and there, like something's going on, something's fishy. We had it under contract. It was a 10-unit building zoned for 9 units. And so we were going to jump through hoops just to get the 10th unit approved or do something illegal. And we go through due diligence and we find that the septic system needs to be replaced. Okay. So first of all, we were at a price point where we're like, okay, this deal can make sense. But we weren't like, this is a home run deal. And news flash, everybody, the majority of deals are not going to be home run deals. You're looking for singles, doubles. You're looking for a deal that makes sense, that actually cash flows 5%, let's say, for the first few years. Or if you can get 4-5% year one cash flow based on your underwriting, it's a good deal, okay? So this one is going to make a few percent year 1 or 2. I don't really recall. It was a couple of years ago at this point. But the point is, we had underwritten a couple of hundred deals. We were eager to get a deal under contract. We got this one under contract, knowing that there were going to be some challenges. And then we go through due diligence and we find out that we need to replace an entire septic system. We then approached the broker to discuss with to negotiate with the seller. Was not willing to budge on price. We were going to have to pay for the septic system out of pocket. Now things are starting to look ugly on our end. And we're like, oh crap, are we really going to do this deal? It'll still make sense if we do X, Y, and Z, or maybe if we reduce our budget here. And we're trying to talk ourselves into why we're still going to do this deal. Were we hard with any money? No, but we had money out. We had already done inspections. We were a few $1,000s in. So yeah, we were going to lose money on this deal. But sometimes it's okay to lose money on a deal like this particular deal and walk away, cut your losses, because you were going to get into a deal at that point. We were going to get into a deal at that point that was maybe not going to earn a good return. Now, had we done that deal, in hindsight, it would have been a pretty good deal based on everything that I know now about underwriting, about changing septic tanks and systems, and the cost wasn't that bad necessarily. We could have ate it. Some other factors to consider were the vintage of this property. It was old, I think 50s or 60s build. It was flat roofs, which need to be changed every 10 years or so, not pitched roofs. It was concrete block. Now back to, again, it was a 9 out of 10 and potential 10 units, but were we going to be able to get that 10th unit permitted? I don't know. So that's a gamble. In this particular submarket, we were not equipped with a working relationship with a property manager. So we had to vet new property managers. So that was a little bit of a risk as well, but we found a decent one that I liked. So in hindsight, it would have been a decent deal with some risks and challenges. Now, flash a year or so later, Hurricane Ian came and really did some damage to that area. And I don't know what happened to that particular property, but I could imagine that it got flooded. So again, this comes down to the fact that I was pushing too hard. And many of us, we all do that. We want the deal to work, but sometimes the deal just doesn't work. So don't push a deal to work. Don't pencil whip a deal with when you're underwriting to make it work. And then when you're under contract, don't overextend yourself for no reason. If you are 100% sure that this property is well undervalued, then maybe it is worth it. But there are so many things you need to consider as a buyer in any market of what is going to make a deal work and what's not going to make a deal work. And sometimes it takes experience. So sometimes it takes that 9 unit, buying it and having it flooded and having the septic system need to be replaced and maybe earning maybe 2-3% a year to understand what makes a good deal and what doesn't. Okay. And of course, we were just going to hit the top of the market at that point. So we would have been buying at the top of the market. And that's another reason that we would have been screwed. We would have had to hold for 5 years or so till the market, because the market's bottoming out, or at least on its way down. We don't even know if it's at the bottom or not. So what we're looking at that point, we would have been looking, this is 2021, we would have been looking at holding, because we wouldn't have been able to refinance at 2022. It's just too fast. And at that point, I believe that hurricane had already hit Ian. Maybe it was a little late 2022. I don't really recall, but it would have been a gamble, right? And that's what I want to drill into your heads. You don't have to get into a deal that is iffy. A deal should be solid. A deal should really feel good on your end. You should not push or force a deal for emotional reasons or for other reasons just to get a deal done. So don't do that deal is the topic of today. Let's jump into some more information here. I had initially said that 1 out of every 100 or so deals is going to work out. Now, I have only analyzed maybe 500-600 deals at this point in the past 5 years, and that's not a lot. People are underwriting deals maybe 100 a week. That might be a little bit aggressive, but the top firms are going to be underwriting multiple deals daily, right? And I just don't have access to that many deals because I have generalized my focus onto one specific market in Florida, the greater Tampa MSA. So there just isn't that much deal flow for me to underwrite. But I do underwrite everything that I see to a degree. Now I've been getting better at spotting what deals are going to make sense and what deals are not going to make sense right off the bat. And some of those tips and tricks I've shared with you before, and I could share again. For example, is it hitting the 1% rule with rent? And my 1% rule might be different than others, but that is it like 1,100? Let's say $1,000 in rent should be about $100,000 a door or better. And in today's market, you really need better based on today's debt and CapEx. So if I'm going into a deal and I'm budgeting a CapEx budget, my all-in cost is 90 a door, and I'm sorry, my all-in cost is $100,000 a door, and rents are $1,000. Could be a pretty good deal, okay, or a deal, right? Just like I said, it's very rare that you're going to find that home run deal. To find the home run deal, you're going to need really to take on a lot of risk, and perhaps you're not really ready for that risk or not financially ready, and you don't want to put that financial burden on other people, because the deals that I've seen that are going to be quote unquote potential home runs are either like something that is completely storm damaged or ruined or have extreme deferred maintenance, extreme vacancy, things that are not really accessible for the common investor. And you got to have money aside. You got to have money capital waiting to be deployed. You got to have access to that capital through private investors, through friends, family, loved ones, through people you know, but people that are willing to get aggressive with that money. You have to be upfront, especially if you're raising that money, about how risky that particular deal is. Okay, so back to that. So that when I look at a deal quickly, yeah, the 1% rule stands out for me. The vintage of the property is super important now that I'm realizing, and also the class. So property class is extremely important. I do C-class properties, and it is intensive. It is labor intensive with a lot of asset management. The property management is run to the bone. I don't even know if that's a saying, but run dry and beat up every day with these tenants that are you got to chase them down for their payments. It's just, then there's a lot of turnover. They don't qualify, so there's a lot of challenges with C-class properties. So if you're buying a C-class property 2 or 3 years ago, at this point, it would have been valued similarly in regards to cap rates to a B or an A class. And at that time, it really would have made more sense to go with the B class or an A class because the pricing was so similar. But today's day and age, right now, C class should be valued at a higher cap rate, meaning cheaper cost, purchase price, cheaper purchase price than a B or an A class. There should be a significant difference. So where we were looking at 5 caps for a C class property, I need sub 5 and even 4 caps for A class or B class, and even some 3 caps for A class properties. Today, the C class property that traded for a 5 cap 2.5, 3 years ago is now going to trade for 6.5 cap. So there's a significant difference. And you know what? Let me give you a quick schematic, a quick workup on how much the valuation would decline. So let's take the NOI. So to get the cap rate, you divide the NOI, to get the purchase price, you divide the NOI by the cap rate. So I just took $100,000 NOI, divide that by 0.05, 2.5 years ago. You get a valuation of $2 million for your property. That's what people would be willing to pay, let's say 2 years ago, for an NOI at $100,000 for a C class. Now, the same C class property, the same exact thing, valued at a 6 cap, is 1.66 million. So you are $3.35 million off your purchase price just because the cap rates have decompressed, have expanded, have gone up. Now let's take that same $100,000 NOI and divide it by a 6.5 cap, which is likely today. So now we're at a valuation of 1.538. So we're almost $500,000 off of valuation, which is extreme on a $2 million property. That is extreme. So pricing difference is very different today than it was 2.5, 3 years ago. Getting back to the original topic now. Let's say, so every deal should not be the deal that you do. Brokers are going to package something and you're going to look at it and you're going to say, wait a minute, I don't think this deal is making sense to me. I would be at 70% of asking price. And if you're at that, you're probably doing pretty good, okay? Because that's how you should be. So then eventually something will come along and maybe you're at 80%, 85, or even 90% of asking. And you're like, this deal makes sense. So you pop in an LOI, maybe the conversations with the broker start happening, okay? Now, at this point, you should really know what you're getting into. So you're negotiating with a broker, your LOI is accepted. Let's now talk a little bit about some red flags, things that you should be looking out for. So, do you know the market? You have to make sure that you know the market pretty well. One of the main red flags is that you're in a market, yes, the market is excellent, but the submarket or the particular neighborhood is not great. Maybe the population is declining or weak, has very little growth. Population growth is crucial. Maybe there's a high vacancy rate in that particular submarket or neighborhood. Maybe there is crime in that particular neighborhood, very different than a few blocks away. This happens, so you have to get eyes on the property. You have to make sure that you know the nuances of each neighborhood. You have to. What about the main employers? Is there job opportunities? Are there multiple main employers, or does the local economy rely on one employer? That is huge. If that employer leaves, just like Detroit, Michigan, whenever that happened, when Ford left, right, it drops and becomes a ghost town. So the same thing can happen in your particular market or submarket or neighborhood. You got to look at the property level issues as well. Just like I spoke about before, when you're doing a due diligence, you got to check out structural damage, mold. You got to check out whether the AC systems are going to fail, all the other building components that they're going to fail, the roofs, etc. And a lot of times the seller is just pushing a price because they want a certain price. It doesn't mean that they're unwilling to accept a lower price point, but they are pushing a price that they want. We all want more. So you can't hate on a seller for asking for the highest possible price point that they think that they can get. That doesn't mean you can't negotiate, especially after due diligence. You get in there, you walk the property, you have an engineer look at everything, you have an inspector look at everything. Now you're ready to negotiate. You begin negotiations. You can get seller credits sometimes. If you negotiate too hard with the seller, they might just drop you, and that's possible too. But don't stress it. There will be another deal. 100 deals, after looking at 100 more deals, you might find another one that you get under contract. Just is what it is. Don't get too frustrated. Just understand that this is how the game works. you got to look at other issues as well, like potential environmental risks, like where is the property located? Is it prone to flooding? Is it in a flood zone? Is it prone to hail storms? Is it prone to tornadoes? So just, I'm sure you've already done this work on that market in particular. And if you have not, now's the goddamn time to do it. Financial issues. Is there negative cash flow? Like, what is the cash flow like? Are they actually collecting rents? Do a deep dive on their rent roll and get an audit, do a rent roll audit, and as well as a, what's it called? A delinquency report, and make sure that that these people are collecting rents. They could lease people up at $2,000 a door, but are the people paying? Are the only people that are paying still at 1,100 a door, and they're claiming that you can get 2,000 a door, but they just got these people in there with these concessions and nobody's paying? Be careful. Okay, so the seller's numbers, and when a broker provides a pro forma or a seller provides their T12s, yeah, you got to take it as face value. You got to take it for what it is. You can't say that, oh, right off the bat they're lying, unless you see something egregious right off the bat. But you're not going to say that. You're going to assume that is correct, and until you get the deal under contract. And they're probably not correct. There are probably some issues or some things that are being hidden or skewed. And that's where, when you get into the due diligence period, you need to verify everything. That's your job as a good due diligence doer. Another thing to watch out, don't underestimate CapEx. Okay, so make sure if you're not familiar on how to build a CapEx budget, get somebody who is. If you don't have somebody that is familiar with it, or if you can't find a partner that will do that, you need to do a lot of work behind the scenes, and it could take you a long time to get contractors available to give you bids. And you can have contractors walk properties, but if you've never worked with them before, you really don't know if they're trustworthy either. So just be careful. Now, is the market really hot? This is another reason why some people might overpay and you shouldn't do the deal. Maybe we'll get so over emotional and we think that, yeah, this is the next biggest, best market to invest in. And there's nothing that's going to turn this down, or we're smoking the hopium. We're believing that this market is going to be the best, newest, and best, next best thing. So just be careful. Don't overpay. That's really it. That's all I got today. But I'm going to give you like a quick outro here, or checklist. So you got to do your due diligence first with vetting the market, then the sub-market in the neighborhood, etc. Make sure this isn't your second deal that you've underwritten. It's going to take probably 80 to 120 to get one that looks like it's going to make sense. Then hire qualified people when you're doing your due diligence to inspect the property. Hire people to help you out and guide you. It could be a mentor, could be me, could be anybody that you know that has extensive experience in this area. Verify rent roll data, verify the T12, make sure the local market, again, has good job growth, doesn't have too much crime, has good job diversity, has population growth, etc. Start stress testing your deal, like rent growth, vacancy. If you're projecting 3% rent growth year over year, what if it's 1%? What if it's 0? What if it's negative? What do the returns look like? Okay, just do this to cover yourself in the back end. And think about this deal as you doing it by yourself. You should do your first few by yourself. Are you willing to take on whatever risk it is that you are projecting with this particular deal? If yes, then go for it. Do not ever get yourself into a negative cash flow situation. That's something that nobody should be involved with. Unless, of course, you're a builder, unless, of course, you are doing a crazy rehab and you have a ton of experience to know that this deal was going to make sense in the end. Partner with people that know what they're doing, experts, expert brokers. It could be real estate brokers. It could be lenders, property managers, mentors who understand that particular market, and use this advice forever. The walk away rule, guys. If a deal does not meet your criteria, if it's not making sense, don't push it. Don't do the deal. Walk away. There will always be more deals to have or to be had, okay? It might be 100 more deals that you analyze, but it's there. All right. Remember, the best deals could be the ones that you don't do. Knowing when to walk away can save you stress, time, and money, just like it did for me. If you want to learn a little bit more about how you can either expand your business, expand your knowledge, expand your network, you can go to my website, www.smalaxecommunities.com, where I offer some resources, but you'll also get access to my newsletter, and you'll get my email address, and you can even find my cell phone number on there. And you guys can message me, reach out to me, and I will help you. All right. So remember, guys, 100 deals until you get one, maybe, and you still might have to walk away. Don't get discouraged. Know that Nico is here for you, and I love you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.